What is going on, everybody? It is Finance Fridays. Finance Fridays. Episode number 7, I believe. Today's video topic is going to be something that is near and dear to all of our hearts, and really affects every single investor that we talk to. We're going to be breaking down conforming and non-conforming, how that works, how that is going to affect your qualification, and basically the ins and outs of why that's important to you as an investor. Looks like we got a bunch of people already on. Everybody, thanks for joining. We appreciate you all. Today we actually have a special guest. So one of our partners, if you guys don't know, his name is Scott. He's been on a handful of our videos. He's the leading man of the video that launched today. Scott has an extensive experience in the mortgage business. He's been doing this for about, I think, 17 years now. He is the reason why I do what I do, and Aaron does what we do, and Aaron does what he does. Scott has been able to guide us and teach us, and basically tell us everything that we know that we can share with you. So he was able to break down what conforming and non-conforming means, how it works, and we're going to bring him on right now.
Hey guys.
Scotty, what's going on, man?
Not much, man. Just doing my thing, working away. Thanks for having me.
Does know.
I got the Friday invite. I feel like I got lifted up a notch here. And I tell my kids I was on YouTube Live, and they're gonna freak out.
For everybody who's on our Instagram channel, unfortunately, you guys can't hear that. You guys can't see this, but he's also on YouTube as well. So, Scott, tell us a little bit about the video, some ins and outs about conforming, non-conforming, why it's important, why investors should focus on this when looking to make a purchase on a rental property.
Yeah, so basically, conforming and non-conforming properties basically speak to the usage of the property, the zoning of the property, and also the building code of the property. So essentially, a conforming and non-conforming property basically is dealt with at the municipal level. So usually between the fire department and the city, and how you can occupy a unit. A non-conforming unit would be something that, let's say the zoning on a property has changed and the tenant was grandfathered into that property. So downtown, let's say they rejuvenated downtown core, and they're changing all the zoning of the properties to allow small businesses, for example, and you've got a straight up rental property amongst small businesses. As long as the tenants, and you can show connectivity between the tenants all the way through with no gap, you get to maintain that non-conforming status of a rental, residential rental property, as opposed to a small business office property and such. And then you get that's called grandfathering. Essentially, you get grandfathered through time, so you don't have to conform to the neighborhood, i.e., whether it be medical office suites, small business. A lot of municipalities are going to these zonings called CBD, and CBD stands for Central Business District. So it's a kind of a plethora zoning, what allows a multitude of uses: medical, office, massage, retail, small retail, and then small commercial. And what you'll have is, for example, where I'm in Guelph, Norfolk Street is a great example, where you have these old charming homes, and all down the street are all office buildings all the way. So there's a lawyer's office, a dentist, an architect office, a massage therapy, and then there'll be just a house where somebody lives in it and rents it. And that house will have the same zoning as the house next door, but they're allowed to use that as a straight rental because it's considered to be what's called a non-conforming rental.
Right. And then in terms of for everybody else who's listening, how does that non-conforming unit differ versus an illegal unit in a building?
Sure. So a non-conforming versus a legal or non-registered unit. A non-registered unit really refers to a unit that isn't registered with the municipality and the fire department, as far as whether it's a suite that's legally allowed to be occupied by a tenant. You'll find this in a lot of accessory basement apartments, especially in older homes where somebody's just added an apartment and they put a student down there, for example, and that's what we call a non-registered. So they haven't gone through they haven't gone through the building code or the fire code to make that unit 100% legal, i.e., they don't have an interconnected fire alarm system throughout the building. They don't have a 45-minute to an hour drywall fire retardant solution where you have what's called fire separation between the two units. They don't have an egress window. Egress windows to be a legal conforming unit in Ontario, you have to have at least one egress window. And there's specific dimensions for that egress window, and that egress window essentially comes right out of the frame, and an average adult human being can get through it in case of a fire. In an illegal non-conforming apartment or a non-registered apartment, you don't have to have an egress window. So, for example, it does pose a little bit more of a fire risk. So, a fire department, if they get word of a non-registered apartment, they'll come down and make you put a fire sprinkler system in the apartment itself. If you're not able, they'll assess the situation, see if you can put an egress window in. But these old 1800s homes, like we have here in Guelph, you wouldn't be able to put an egress window in a fieldstone foundation. It just wouldn't work. So they make you put a fire suppression system and a sprinkler system.
Interesting. So when it comes to, we have a lot of clients, like yourself included. So we all have a lot of clients who come to us and they say, look, I got a house. My house has a separate entrance to the second unit that I have, but it's not legal. We deal with a lot of clients who are trying to house hack, per se, and trying to find a way to have other people pay their mortgage without necessarily having to have a duplex. How does that work in regards to like financing? Like I know we have a handful of B lenders, but in your experience, what have you been able to do?
So as long as you're not using the income for the unit to qualify in the debt servicing, AAA lenders are usually okay having a non-registered unit. The very first thing you want to do is check with your insurance company. That's number one. Can I get insurance for this, and am I covered if I do have a tenant in the basement and they start a fire? Number one, absolutely. You need some sort of rider on your insurance. Your insurance company has to physically, in writing, tell you that they understand that you have a tenant there. Because if they don't, you run the risk of your insurance policy not paying out if something were to happen with the property. So number one, obviously, always start with your insurance company. If you can get your insurance company to give you an insurance rider that says they understand that you have a tenant in the basement, then you're fine. Now, there are other things that can happen, though. For example, if you do have an unregistered unit, you can at any time receive a non-registered unit complaint against your property, where they actually put a stop work order on your property, so you won't be able to do anything to your property. You won't be able to build a fence or a deck or put a pool in or a porch or anything that requires a city permit. You won't be able to get until you actually make that unit 100% legal, or you take out the bare bones that would make an apartment, i.e. a kitchen. Most municipalities just make you remove the kitchen aspect of it, and then it's no longer considered an apartment.
Interesting. So gotcha. There are a handful of B lenders out there that have some interesting products, or extra kind of, I don't know what to call them, just like additions to what a regular mortgage would allow you to have. So these B products, we preach about these a lot. There are a lot of options that are given to you, and some of the options available. Some B lenders, if they have a separate entrance, they will allow you to use part of the rent to qualify, specifically because it's not an insured mortgage product. It really just depends on case-by-case basis. If it's a separate unit, if it has its own entrance, there are some other variables that go into effect, but there are options available. If people were in that situation and still had to qualify, use the income, unfortunately, banks, they're not going to allow you to do it. They're very by the book. You fit in the box, you check all the boxes, and you get A lending. So if you're in that situation where you do need that income to qualify, and there are alternative options available.
Yeah, I know some of the B lenders that we work with, they'll even allow you to live in the non-conforming unit. Like if it is a basement addition, live down there, and you can claim the primary unit rent on your application to be able to use that. So that might be a key strategy for some people to kind of keep in their pocket if they're looking to purchase an owner-occupied building or a building that's potentially non-conforming, is to kind of use that strategy.
Absolutely. There's always workarounds as far as debt servicing is concerned. You touched on the B market. I think the subprime market's perfect for anybody who's looking at purchasing a home that has a non-registered unit. Obviously, number one, once you get past the hurdles of understanding that at any time you could get a non-registered complaint against you, if you're okay with that and you have the wherewithal to make it legal if that's what you need to do, definitely turning to the B lender or a subprime lender is great because they're debt servicing and offsetting, and you guys know this, debt servicing and offsetting on a B mortgage or a subprime mortgage versus a AAA mortgage is just the solutions help you not only on property number one, but they enable our clients to get property number 2, 4, 5, 6, 7. So at the end of the day, if you are looking at a property with, a non-registered unit, then definitely we're gonna steer that client to the B mortgage all day long.
Yeah, for sure. Now, one of the questions that we had when we did a questionnaire this week that came up was wholesaling deals and how to finance wholesaling deals. We wanted to touch on this, the three of us together, specifically because many of you are looking for your off-market deals as an opportunity to be able to start investing, whether that's getting into a flip or a BRRRR. You guys are trying to find the cheapest property possible to be able to value add as much as possible and get it going. So one of the things we want to talk about today was wholesale deal financing and how do you get it done with an A bank. So essentially, we're just going to rip the Band-Aid off. Unless you can go to RBC, you can't really get it done with an A bank. Most A banks aren't going to allow you to do a wholesale deal, or at least they won't wholesale finance the wholesale fee. The wholesale fee is something that they have issues financing. If you have the ability to be able to pay the entire wholesale fee and then qualify for the loan, obviously there are a handful of different requirements that would be required from the lender because it is an off-market deal. It's not listed, but it is possible to get done. It's just the wholesale fee does pose a concern to quite a few lenders.
Yeah, I think the one thing we're working on right now too, Josh, is we're working with one specific lender right now where if we do take a wholesale deal to them, will they allow the wholesale fee to be included if we get 2 appraisals from 2 separate appraisal companies? And that's something they've taken back to their credit risk team right now. Because at the end of the day, property value is determined by one thing and one thing only. It's what a willing buyer and a willing seller are able to agree on to purchase a property, essentially, right? We know that refinances are all based on sales. And sales are based on what I'm willing to give you for your property and what you're willing to take for your property. So if we have 2 adults who are willing to transact a property at $280,000 or $300,000, irrespective of whether one adult was willing to pay $240,000 for that property, the end value of that property is $280,000. And if we can have that backed up by 2 appraisals, then there's virtually no risk to the lender whatsoever. And that's our argument to the lender is essentially, you know what, at the end of the day, you're getting 2 evaluations of property opinion. Like at the end of the day, it makes sense to do the deal with the wholesale fee, because it takes the burden out of the borrower. Because the borrower's going to need obviously that cash. There's a reason why they're wholesaling. They're going to need that cash to maybe fix up the property, whether they want to, whether they want to fix it up, whether they flip it, whether they fix it up and pull equity out to move on to the next property. Every single dollar we can keep in our clients' pockets obviously is better for them and better for us in the long run.
100%. Our job is to ensure that our clients are making money. If you guys aren't profitable, it doesn't make any sense. And then we aren't profitable. We want to make sure that you guys are profitable. Now, one of the things that you guys need to keep in mind when purchasing these wholesale deals, probably the most important thing that a lender is going to look at is the condition of a property. Now, these lenders are essentially adding this property to their portfolio. You see it as adding to yours. They're adding it to theirs because they had the loan on the property. Now, they're not going to take a deal that is decrepit or is falling apart. Why would they add that to their portfolio? If you don't want to add to yours, kind of thing. So they have decently stringent guidelines in regards to what they can and can't take. If you're buying a 70s dated house, you can rip out shag carpet and repaint the house. Like that's okay. We can deal with that. It's when you start getting into structural issues, cracks in the foundation, leaky roofs, water damage, mold, any of those things that come up are hard stops for a lender. So, we are working on our end to try to find a solution to help all of our wholesalers or investors get into B financing without having to take that first step into private finance. It lowers the barrier to enter the market. It stops the fees, and can help you guys kind of move forward without having to have as much upfront capital, which is our goal. We want as many people as possible to grow their wealth in real estate. But we need to make sure that these houses that we're going to try to push in or have approved, these need to be solid properties. That these need to be cosmetic flips.
Another thing to keep in mind too, that I think something we've seen quite often for just what the terms of it are, is buildings that are 100+ years old. I know I had one recently. I think you had one within the last month or two as well too, where anytime a building that we get that it's 100 years older, 100 years old or older, requires an exception from the risk department on the lender. So if, first things first, if you don't see a build date on the MLS, definitely make sure you look into that. I know on the deal that I had, the lender picked it up the day before. It wasn't listed on the MLS and it was only listed on the appraisal. It caused a little bit of a slowdown on the lenders, but we were still able to get that funded the same day. But just something to be aware of. If you don't know the age of the building, and it looks like it could be 100 years old, definitely make sure you find that out if it's not specifically listed on the MLS, or if there is no MLS, make sure you check it out. Could cause some problems with your deal, even if the building is in good shape.
Yeah, what you're speaking to there is what's called the economic life of a property. Every property has an economic life, and the appraisal will give that valuation over time. And that end time is essentially when that property, what point in time does that property not become viable as a living dwelling anymore? Will it need to be torn down and actually rebuilt? And that's why we get into those properties. And we saw a few there last week where, you get in those 1800s properties. Well, those houses are pretty much at the end of their economic life. And they're going to start to need major structural changes, not just the carpet and windows, like we're talking about joists and foundations and such. And that's why it's so important. You're right, Aaron. It's so important to know exactly when that house was built.
Exactly.
Agreed.
A couple questions coming in here too.
Yeah, let's just touch on this. Actually, Scott is one of our resident experts on commercial and construction loans. So one of the questions that we had come in through Instagram was, is there such thing as a construction mortgage, and what are some of the conditions and terms around a construction loan?
Yeah, absolutely. There is such thing as a construction mortgage, and that person that asked that question, I'm going to answer column A and column B for you. So let's make column A residential construction mortgages. I'm going to column B industrial and commercial and multi-use residential mortgages. Basically, a construction mortgage is essentially a draw stage mortgage where you're taking money over a period of time based on milestones in which you hit in a project. Let's talk about residential really quickly. There are basically three major milestones in a residential construction mortgage. There's a foundation, excavation and foundation, lockup, and 97% complete. Excavation and foundation of construction mortgage is exactly what it is you excavate the ground, you put the services in, you get everything ready to go, you put the foundation on, and then that's draw stage one. So you would take some more money from the bank, and then you would get set for draw stage two, which is lockup. And lockup is essentially all the framing, all the Tyvek, all the windows and the roofing and the doors put on. Now, the outside may not necessarily have the brick or the stucco or the aluminum, may not have the shingle roofs on, but it is exactly what it is. You're able to secure that house now lockup. And the reason being is that you can now start to get your internal services inside, your plumbing, your heating, your ventilation, all of your electrical can now start to go in the house because it's now secure. And then your final draw stage would be what's called 97% complete. And that's essentially the final stage to get your landscaping, your driveway, all of the back infill and the foundation, all that done. And then the fourth stage of a draw stage mortgage, if you can even call that, is what we call takeout. And your takeout's the mortgage that you're going to be left with over time. And that's your typical 5-year fixed mortgage. On the commercial side, things end up being a little different, or it can be a little different, and a lot more draw stages along the way. So in a construction mortgage, let's say you're doing a commercial project, you can actually get mortgages prior to a construction mortgage. You can get what's called a mezzanine mortgage. And a mezzanine mortgage allows you to use the land as security to go out and get, use the equity in the land to go out and get money for architecture, drawings, site plan approval if you need to go through the full site plan process. Environmental studies, wind studies, solar studies, if you're backing on a conservation, a GRCA study, all these different things, fire study, a traffic study. There's lots of different things that go into getting approval to actually start putting bricks or cement in the ground, excuse me. And then you move on to the construction phase. And then this construction draw phase is typically a servicing phase. Then after servicing, you typically have your excavation phase, the servicing excavation. Then you've got your foundation, which is typically in a commercial, whether it be a parking garage or actually just if you're not doing parking, just a regular building, you would have your foundation again. And then you would have your framing stage and your major mechanical stage up on top, because your major mechanical goes in from the top of the building on a commercial as opposed to inside the house. And then you would get to your lockup stage, and then you would go to your finishing stages and such, and there'd be many stages in between. A commercial construction mortgage could have 10 to 12 draws in it, where a residential construction mortgage typically has about 3.
Very thorough. And we had a bunch of questions come in about your construction mortgage, actually. How does qualification for a construction loan work for a residential property?
For a residential property, it's all about debt servicing, everything about your personal debt servicing. Residential commercial mortgages are a little tricky. You have to be able to service the debt. Typically on a construction mortgage, what they'll do is they'll take the interest accrued out of the first draw, so your interest is always accruing, and you pay it down as a lump sum part of your draw. And as you move on to the next stage, you take your interest for the next draw as an accrued interest lump sum draw until you're done, until your end mortgage takes out everything. Some construction commercial mortgages, on the other hand, will take like a year's interest up front. We just, like Josh, Aaron, we're working on a really large commercial construction mortgage in Kitchener, Ontario right now. It's over $60 million. And that one they're taking their interest in yearly draws. So they're going to take their 1 year's interest out of the first draw. And then on the second draw, if they get to more of a milestone of it being built versus the time in which they're there, they're going to adjust the interest as they go and maybe take another year's.
Yeah,
love it. What was the second question?
Last question for residential construction mortgage. Is this in addition to conventional mortgage, like a second mortgage? No. I think Scott actually just kind of touched on it a little bit. It's like a general charge over the property, and then it's tranched in phases to give you funds to be able to complete the project. And then once the project is complete, you have your takeout financing, which is the charge that it would be essentially on your property, which would be the mortgage that you owe to the bank.
That's right. So if you've got somebody, for example, that has a mortgage on their property and they want a construction mortgage to either put a renovation on their home, you wouldn't really use a construction mortgage for renovation, but you could use a construction mortgage to build a brand new home where the old home was. On the first draw, that first draw stage would typically pay out the first mortgage that was already on the property. And again, that's why you need a decent amount of equity in your property to start this. Somebody who purchases a home for 5% down wouldn't be able to go and get a construction mortgage on that same home 2 years later. They just wouldn't have enough equity.
Right.
Typical equity situation you want to be in is 50% or less on the property before you think about reconstructing that property.
Yeah, especially if you're using that equity to cover the cost, you don't know what kind of hiccups you might run into along the road as well too. You want to make sure you have some sort of capital expenditure on the side and reserve funds to be able to pay for any additional permits or any bumps you may run into. You never know.
The lenders are typically looking for about 10% of the entire project held aside as an overrun.
Yeah, I can truly say I don't think I've ever met or heard of somebody with getting a construction loan and everything going exactly to plan, exactly on budget. It doesn't happen. So, having a large equity position is definitely needed to be able to build something, especially your dream home, because you realize very quickly that the quartz countertops you wanted were actually marble, and the custom kitchen is now twice as large. So everything happens.
Yeah, well, especially
things change.
Yeah. And lack of materials. If you have to change, like you're building a deck out the back or at the front, and wood is no longer available, you're gonna have to pivot and look at something else. And you're either gonna have to go with the cheaper option or a slightly more expensive option. So
absolutely. And then you're subject to the weather, especially here in Ontario. You're subject to the weather. One day it's 10 degrees, next day it's rain, the next day it's minus 20. Like, your trades can only work when they can work, right? At the end of the day. Yeah. You want to essentially, on a construction mortgage, number one, you want to work with somebody who understands it. Right. So you want to get with the best, because you want to set yourself up for success. Because once you're in a construction mortgage, you're in. Like once you tear that house down or you put that foundation in, you're in, right? There's
Scotty, maybe touch on how important like a known GC is as well too, in terms of who you're working with and what the lender's going to look for.
Yeah. So depending on the size and scope of your project, your lender's going to require what's called a cost consultancy report. That cost consultancy report is basically a pure study. So they use a number of general contractors who are known in the area or known in the business to have bang on costs for a certain project. You want to make sure that your general contractor is pretty up to speed with how much it's going to cost to build this for you. You want references. If you're going to build a house, you want your GC to give you at least 3 or 4 references of homes they've built in the last couple years at least, because building codes change, electrical codes change, roofing material goes through excuse the pun, goes through the roof. We saw that about 10 years ago. Roofing material doubled. Concrete's very expensive now. So you want somebody who understands today. What do things cost today? What's the temperature of the trades today versus 2 years ago? How many roofers are in the area? How many framers? How many drywallers? How many electricians? Kind of thing, right? Because you're going to want to get your trades on site. And if you're building one property, you're going to have a hard time getting your trades on site. But if you're building a multi-residential 80, 90, 100 units, you're obviously going to have a fixed cost contract. But those costs, like you said, that's why you need your overruns, because those costs are going to vary as you go.
Yeah. And what if someone wants to build their home themselves? They don't want to use a GC. They are the GC. How does that change, and what would a lender look at?
So here's the thing. If you're building your home yourself and you're not using a GC, depending on your lender, you may or may not have to apply for a tear-on warranty. And a tear-on warranty is essentially, if you're doing a renovation on a home, that's not a new home, so you don't need the warranty. But if you want to buy a piece of land out on rural road number 4, 2 acres, you want to build a 3,000 square foot bungalow, you're going to need a tear-on warranty on that house. So you're either going to go through all the rigmarole of applying for one yourself, which I wouldn't recommend, or you're going to want to hire a GC. So what people normally do in that situation is let's say they're handy. Let's say, for example, they're a gas fitter. They're an HVAC gas fitter. So HVAC gas fitters are pretty handy, and they know everybody. They know framers, and they know electricians, and they know foundations guys, and they know roofers, they know windows guys, and they know excavators and landscape architects and engineers. So they want to be their own GC. Typically, what they can do is they can hire a GC who's willing to oversee the project from a paperwork standpoint, so they can use their tear-on warranty, and they would pay them a fee to do that, but much less of a fee than a general contractor would charge to manage the entire project. So there's a little bit of a hybrid there where they could pick up a GC for a little cheaper, and they oversee the project because really they know what they're doing.
Interesting. And if you don't want to hire a contractor, for example, that's has tear-on warranty, there obviously are alternative solutions in the market that would allow you just give you money to build it yourself.
Absolutely. It's just, you have to remember that you're going to have to hold on to that property for a certain period of time. I don't want to say what that time is. I'd have to look it up, but you'd have to, like a new home warranty lasts for X number of years. So you'd have to make sure, if you don't have a new home warranty when you're building that home, you're in that home for a while.
Yeah, for sure. We had a bunch of questions come up. One of them I think we just already touched on, but what is the economic life of a property? Is there a rule of thumb to keep in mind for economic life? For example, when purchasing older properties for flips? Yes.
Is it 100 years old?
100 years old, basically. If you have it over 100 years old, most lenders are going to want, like, it's not a hard stop, it's a exception. And if you have gutted it and you've redone, if you see the value in a property, if you've put in new electrical wiring, if you've redone the plumbing, like if you've done a full gut on the property and you do a flip, we can make that case as long as the bones are good and we can show that you've redone the entire house and the value's there. We can do it. Now, that's an exception. So, if we're looking for 2 or 3 or 4 exceptions, like because your income doesn't match or like you need an extra offset or it's a handful of things that go into getting deals done. So as long as maybe that's the only exception, they're happy to play ball. These are institutions, but they also understand how it works. So they have a little bit of leeway when it comes to being able to give an exception depending on what you're asking for. So I would just say I'd keep it around 100. Anything over 100, you might have a bumpy road trying to get that one done. Yeah,
if your 100-year-old property requires $40,000 of updates on the inside and whatnot, you might have a problem.
Right, and you can always get so in the situation we had in the office last week, the lender's going to want to see the inspection report. This inspection report really speaks to the upkeep and the modernization of the amenities of the home, i.e. galvanized plumbing versus the regular plumbing, and it escapes me now what it is, but galvanized plumbing is a big one, especially with old homes in the 1800s. That's a big one. That's got to go because some of that galvanized plumbing was made with lead. And then, knob and tube wiring, we know in this business is a hard stop for all, if not most lenders. And it goes on and on from there. I would say an inspection report, and on the commercial side, a building conditions report. And again, you guys can speak to that deal we had in London, where we needed a buildings conditions report for a building that was well over 100 years old, but it had been totally modernized in 1982. And so we had to get a building conditions report. They came back great, actually, and the lender ended up doing the deal. So, those are your tools to help you along the way, for sure.
For sure. And, those upfront costs are they're not cheap, but then again, neither is what you're doing. So, I mean, it's a lot cheaper than getting into a situation where you're burying $100,000 into redoing an entire house when you weren't expecting it. So those reports are really important. And unfortunately, if you're getting into this type of investment, you're going to have to assume the upfront cost when assessing risk for a deal.
Yeah. Also, I just want to add one thing on buildings over 100 years old. If you're purchasing a property over 100 years old, 100% check with the city and check on its heritage designation. Yes. You do not want to be getting yourself in a mess with heritage designations. It's a nightmare. AAA lenders won't even touch them.
No. Yeah, it's a great point. I don't think I've seen too many, but I have seen one deal come up where it was heritage, and it's just pretty much a full stop once you kind of get to that point.
Yeah, we had one in Cambridge a couple of years ago on the river, right on the Grand River, where it was a flip. Actually, the guy was purchasing it and turning it, was modernizing it into an office, and it was a gorgeous, gorgeous home. It was a hard stop. It was just, it had heritage designation. We couldn't even touch it. We ended up going 100% private on it.
Jeez. Yeah. One other thing I want to touch on too is if you do come across a property that requires a lot of updates because there's mold or some sort of formaldehyde or asbestos or something like that too, you may be looking at like a vendor holdback as well. So that's kind of something to keep in mind in terms of moving forward, where some additional costs may be. You may have to come up with the additional funds up front just to be able to move forward on the closing. If you don't want to look at a private solution and you're trying to get some sort of institutional funding, just as another kind of point to keep in mind.
Yeah, if the property's got good bones, but there's like one glaring issue, like formaldehyde insulation or specific mold in a certain area of the house, but everything else is fine in regards to holding value, a lender will do a holdback, as Aaron said, and could cost anywhere $10,000, $20,000 depending on what it is. But if you like the deal and it's worth it, it makes sense to just do the work and have it done.
We had that last year. Remember that farmhouse on Wellington Road in Wellington County, Wellington Road 32, where our buyer purchased the home, but it had a dirt floor in the basement. So the lender held back $35,000 closing. He went out and got a quote to have the basement dug down, dug out, and put a proper concrete floor in. So the lender held back. He got it done, and as soon as it was done and inspected by a home inspector, the funds were released within 72 hours.
Yeah, that's great.
And then on the flip side, I guess if we're on the topic, another thing that you can look at for some of these insured and conventional is a purchase plus improvements mortgage as well too, right? Where if you're to build that in, the lender has the ability to build in approximately $40,000 into the mortgage value to be able to cover some updates and some renovations to the home too. So it is a conventional mortgage, typically has to be insured or insurable from what I've heard from some lenders. I think Merritt's does an insurable mortgage with purchase plus improvements, but again, can be a great way to get some value back. It is a rebate type program, so you do have to have the funds up front and would have to qualify for the total loan amount. But another way, they do rebate you the cost, so it does get paid back out on the back end.
Yeah, they're great mortgages. It's a great point, Aaron. MCAP actually has a really good purchase plus improvements conventional uninsurable mortgage, but they one stipulation is that it's a single draw purchase plus improvements, so you have to fit the entire purchase plus improvements bill before you actually get any money. So you got to work with a contractor who understands that, and will take maybe a deposit and wait for full payment maybe 4 or 5, 6 days after completion. But that's a phenomenal solution that everybody out there should be using right now, because every single person that buys a home, whether it's a rental property or principal residence, within 90 days, they're going to start getting tired of the things that didn't really bother them when they first, or didn't notice when they first walked into that house, like the windows that don't close properly, or the front door that's so drafty it can blow marbles down the living room floor, right? Like, these are the things that people, all they see is the neat stuff, like the new stove or the great lighting, right?
Yeah.
But once you're in a property, you start to see these things. And as well as I do, once you're in a property, you're in. Like, you're, especially 5% down. Once you're in, you're in. And you can't do anything to your mortgage once you're in, especially within the first year. Most lenders won't touch you within the first year. So yeah, why not go out and get some quotes for some new flooring and some new windows and some new doors and maybe a new roof and
a new office for all you work from homers out there.
Amen. Yeah, that's a great idea.
Put in a new office.
Home office,
You can get $40,000 to put a new office in if you get some quotes and stuff. So
Sure.
Reconfigure your basement to include a home office for you. We can get that money and include it in your mortgage at a great rate too.
Yeah. Last but not least, we had Zachary chip in from Facebook. It reached out and asked us a question. He said, on a 15 plus unit building, how much the loan needs to be guaranteed? I'm not too sure I quite understand the question, Zach, but all of it would need to be guaranteed. So usually when someone's buying a multifamily apartment building or multifamily above 5 units, most people put it in a corporation. That corporation is essentially the applicant, and you are the personal guarantor, meaning you 100% wholly personal guarantee that loan. But the actual owner or the person on title of the loan is the numbered company or the company that you created, the holding company. Most commercial loans are around 30% down payments. It really depends on, obviously, again, there's a theme here, the condition of the property, how strong you are, the NOI, how much income can the building actually support in regards to debt. Like, there's a handful of different variables, but on average, if you're looking at multifamily, I'd say base it off 25, 30% down payments. You have to personally guarantee the entire thing. And it's quite easy to crunch numbers once we have the NOI and the expenses in the property. We'll be able to tell you with pretty close certainty as to how much debt could be supported on that property.
Yeah, excellent point, Josh. There is a multi-unit CMHC product out there that allows 15% down, but it's such a AAA product. Like, the building has to meet, the demographic has to meet, the tenants have to meet, that the net worth of the borrower, the acumen of the borrower has to meet certain criterias. And I know you're 100% correct. So the rebuttal to your answer there might be, well, I've heard about this 15% down. You're 100% correct. It is out there. It's for the cream of the crop buildings. It really is.
Yeah. The big buildings with anchor
20 stories for the skylines and the homesteads and Yeah.
government.
The product's out there. It is out there. It's a navigation through a sea of paperwork. There's an application process for that. It's $250 a door. You can get, there are some phenomenal interest rates if you do qualify, but there's a non-refundable application fee of $250 a door, and then from there, it's the process itself is about 90 to 180 days for approval.
Yeah.
So it's not something, if you're looking to pick up an apartment building on January 27, it's not something to ever into. Not at all.
There are also limitations on what you can and can't do with the equity takeout later on down the road if you were looking to pull equity out. We're actually going to be making a video series on CMHC financing in the new year on commercial real estate. So make sure you stay tuned for that. We're not going to give everything away, but we're definitely going to share all the knowledge with you guys. We have one more question. So what if I can't show personal income in a multifamily, but I have some cash? If you're purchasing an as-is property, which is midway under construction? Okay, let's answer the first one first. So
Personal net worth.
Personal net worth. Yeah, you can go.
Yeah. So the commercial buildings, once you really get outside that 5 to 6 unit, the whole reason a lot of people get into the commercial, one, obviously the cash flow, but two, you're looking more at the building debt servicing itself as a self-sustaining asset, and not if you're personally able to debt service it, which can be a huge plus for a lot of low income showers who have a large personal net worth, but maybe aren't showing a lot of money on paper. One of the things that the lenders are going to take a look at is, what does your personal net worth look like? How liquid are you? What can you show in your savings? Do you have the capacity to cover the monthly cost of that building if for some reason you enter into a pandemic and a lot of your tenants are unable to pay their rent? Are you able to service it yourself just with liquid assets? So if you don't show a strong income on paper, that can be all right if you have a pretty strong liquid net worth. So that might be able to kind of make up for your lack of income.
Yeah, we understand that the majority of our clients who do show very high net worths are business owners, and we get the game. Business owners, you guys try to show as little as possible on paper, but you can't have no net worth and have no and no qualification and just a ton of cash. That doesn't really reduce the risk of the lender, because the lender still needs to have some sort of confidence that you're going to be able to make those payments.
Yeah, there are some credit unions out there who allow you, sorry, Scotty, just
Go ahead.
borrow debt servicing off of additional properties if you have them all under the same lender. So if you had a really high performing cash flowing property, debt servicing maybe 1.4, and you had a property that was debt servicing 1, you could potentially take that additional 0.2%, carry that over and help even out the entire portfolio, and either, have the lender, maybe they were at 55% loan to value, maybe you can get them up to 60, 65, 70% loan to value. It may not be their highest LTV, but it's a lot better than showing them a building that has 0.8 or 0.1% or 1.0% debt servicing, being able to borrow that cash flow. So building a portfolio under a single lender can help being able to leverage other properties.
Yeah, perfect. Well said. Yeah, I think debt servicing on a multi, if we're just specifically speaking about multi-unit residential, debt servicing is key. You as a person, or a guarantor, a borrower, needs to show that you can take care of your house. You can take care of your finances. So you're gonna go through a debt servicing qualification on your personal residence and your borrowing ability. And then once you cross that hurdle and the lender can see that you've got your stuff all sorted out, then we move on to the property, and then we move on to the debt servicing of the property. So you don't necessarily need to personally debt service a 15-unit apartment building. Not very many people could.
Yeah.
What you need to do is show the lender that you've got your house in order.
Yeah.
Exactly.
And last question from the same gentleman: if you're purchasing a as-is property, which is midway under construction, and assuming the previous homeowner did work without permits, will this be an issue for mortgaging with an A lender?
Yes.
Number one, yes. If you are taking a property that is in the middle of construction, you are not getting a mortgage from an A lender. if you are purchasing a property that currently had work done and has outstanding permits on the property, you're going to have a hard time purchasing that property and selling that property. Scott knows all about that with his pool.
I do.
Scott is currently dealing with that. But yeah, any open permits is going to be an issue with selling or purchasing property.
Yeah.
So
A-lenders will want the building to be at 97% completion before they will put any mortgage on. And that's the same for a conventional B lender as well, I believe.
That's right. What's the gentleman's name that asked that question?
blcr.contr.lst.
If you want to reach out, we could.
Yeah. So the person who's asking that question, if you're still listening, just because the permits weren't taken out in the beginning doesn't mean they can't be taken out now. If you're thinking of purchasing that property, my very first step would be to contact the municipality in which that property is in, and have the property inspected by a local building inspector, just so you can get an idea of what you need to take out. Because if there are no permits on the property, the city has the right to make you demolish the entire building right back down to the ground, right back down to the dirt. But municipalities are usually pretty good about it. What they're going to do is they're going to go in and say, okay, well, this isn't a code, so you need to change this. And this isn't a code, you need to change this. And then you basically make the decision on whether or not it's cost effective to do that. So, but to reiterate, just because there's not a permit on there now doesn't mean you're not going to be able to get one. Obviously, to get a mortgage right now with a property that isn't permitted, we would have to ensure that the permits would be able to be taken out, and we'd be able to be taken to fruition and cleared off. We would bring in we have private lenders in our stable of lenders who aren't shy about those types of mortgages. We would get you into a private mortgage. They're not cheap, but it would enable you to get at least to a phase in which you've got permits in place and the work is now up to code. Once we provide a building inspection report from the city showing that the permits are in place and the building is now back on track and is up to code as it stands at the level in the project, then we would be able to lower your interest rate.
Perfect. Right on. Well, Scotty, we always appreciate your knowledge. You have more knowledge than probably 100 mortgage agents. So we really appreciate everything that you do.
Not 101 though. 101.
Not 101 though.
The extra one isn't going to cut it. We do have a lot of questions here. Unfortunately, couldn't get them all today. Guys, feel free to reach out, drop us a DM. We would be happy to answer any questions you might have, or even if you guys are dealing with an issue with permits or in the middle of construction or looking at a BRRRR, Scott, myself, Aaron, we are always up for a conversation just to give you guys advice on what to do and how to navigate that specific type of lending. Again, Scott, we appreciate your time. Everybody else, we appreciate everybody tuning in. We wouldn't be able to do any of this without you. Next year is going to be absolute fire with content. We're super excited about it. We are excited to see all of you grow in the 2021. So thanks so much, everybody. Have a great weekend.